When a charity receives a donation of fine art or real estate, they immediately call in the experts. They appraise it, monitor its condition, and track its market value. But when it comes to one of the most common assets in America, the documentation is usually just stuffed into a file cabinet and forgotten. That asset is life insurance. Roughly 51% of the U.S. population owns a policy, yet it remains an overlooked subject in charitable planning. Organizations gladly accept the paperwork, file it away, and simply wait to collect the death benefit. This diagram illustrates the structural problem with that waiting game. These lines compare the original high-yield projections against the reality of the last several decades, where interest rates fell and stayed low, causing many policies to miss their targets. At the same time, life expectancies shifted. Demographic data shows that wealthier individuals, the exact people most likely to donate a multi-million-dollar policy, are now outliving those original actuarial tables by 10 to 15 years. When a policy earns less interest than expected, and the insured person lives a decade longer than planned, the internal cash reserves drain rapidly. Suddenly, to keep the coverage active, the insurance carrier demands significant, unprojected jumps in annual premium payments. Most charities have zero protocol for this. When a six-figure premium bill arrives in the mail, the typical response is panic. Without a way to evaluate their options, organizations usually do one of two things. They either stop paying and let the policy lapse, or they surrender it back to the insurance company for a fraction of its true value. By treating these policies as an administrative headache instead of actively managed financial assets, charities are unknowingly vaporizing millions of dollars in potential funding. There is a third, highly regulated alternative to lapsing or surrendering a failing policy. It's called a life settlement. This is a transaction where the policy owner sells the life insurance to a third-party buyer in exchange for an immediate lump sum cash payment. If you map out the financial options, it looks like this horizontal scale. At the very bottom is the cash surrender value, the low offer from the insurance company. At the very top is the final death benefit. A life settlement buyout lands in that middle space, yielding significantly more immediate cash than surrendering the policy. But before an organization can make that choice, they have to run the math. The mandatory first step is executing a thorough break-even analysis to see exactly how the policy is performing. This means pulling current illustrations from the insurance carrier, projecting the true future cost of premiums, and authorizing an independent, non-invasive health evaluation of the donor to get an accurate life expectancy estimate. Without running these numbers, a charity is flying blind. They have absolutely no way to distinguish a toxic liability from a valuable asset sitting right under their nose. To see how this math plays out, let's look at a real-world case. A 79-year-old donor holds a $5 million life insurance policy that he originally bought for estate planning purposes. He has already gifted away most of his wealth, so he no longer needs the coverage. The immediate problem is the maintenance cost. Keeping this $5 million policy alive requires a $150,000 annual premium payment out of his pocket. The default plan proposed by the charity was simple: surrender the policy back to the insurance company to eliminate the premium, and walk away with $250,000 in cash value. Before signing the paperwork, the donor's wealth advisor intervened. They requested an independent valuation to check what the policy could command on the secondary market. The appraisal discovered that the policy actually held a life settlement market value of $1.5 million. Simply pausing to reject the default option and ordering an independent appraisal identified a liquid asset worth 6 times the surrender value. This data table illustrates the final choice. Looking at the third column, the charity secures a $1.5 million cash buyout through a life settlement. Compared to the middle column, that represents $1.25 million more capital than the standard surrender option they almost accepted. On top of the payout, the transaction completely eliminates that $150,000 annual premium requirement. Because this transaction happened now, rather than decades in the future, the living donor actually got to see the tangible results of his gift while attending the charity's annual gala. And with the policy sold, the donor took the $150,000 he used to budget for the annual premium and redirected it into immediate monthly cash donations to the organization. The solution here is straightforward. Charities should evaluate donated life insurance with the exact same rigor, expert consultation, and independent appraisals they already apply to fine art. This requires actively monitoring in-force policies, checking their performance against current interest rates, and demanding non-binding appraisals before ever letting a policy lapse. By treating life insurance as a dynamic, manageable asset rather than a static piece of paper in a filing cabinet, charities can rescue failing policies, deeply engage their living donors, and reclaim millions in dormant capital.